Welcome to PhillipCapital Weekly Market Watch. My name is Victor Y from Unit Trust Research. In this week's market commentary, we are going to look at the sustainability of the big party Wall Street is throwing. Probably the question on every investor's mind: should I accumulate or should I take profit? Well, before we answer that question, it is worth remembering in March 2000, S&P 500 reached a record high of 1,527 points before tanking 20% the following year. 6 years ago, the index hit an all-time high in October 2007, only to suffer a 42% dive a year later. Although past performance is not necessarily indicative of future performance, the economy was in much better shape on the two previous occasions when S&P 500 peaked. The current unemployment rate is stubbornly high at 7.7%, while unemployment rate was 3.9% in year 2000, 4.7% in year 2007. Hence, it should really worry investors if this is the time to enter the stock market. Is a pullback likely? I certainly think so. It is worth noting that the ultra-loose monetary policies by major central banks are holding equity prices ransom. The Fed is expanding its balance sheet at $85 billion per month. At the same time, the promise by ECB to do whatever it takes is artificially suppressing sovereign use of troubled economies. Equities retreated nearly 2% in 2 days when the minutes of January's FOMC came out, which showed the committee was divided on the effectiveness of QE. Mr. Ben Bernanke is likely to step down in 9 months' time. Should growth in the world's largest economy be sluggish still, asset repurchases strategy may well be abandoned. Cyprus stole the limelight in recent days as the small nation struggled to unlock a bailout package by the Troika. The banking crisis was preceded by the inconclusive Italian election, whereby forming an Italian government is close to mission impossible. Spain's ruling party, Partido Popular, is not as popular after it was hit by a corruption scandal, just at a time when Spain is tackling its 25% unemployment rate. Meanwhile, Greece contracted 5.7% in the fourth quarter. Although the Cyprus episode did not result in a sharp correction, it may well serve as a template for the troubled club-med economies. I mean the Southern Europe economies, before the completion of a banking union. The consequence would be catastrophic should the same treatment be applied to Spain or Italy, as these are major economies. We can always count on the Americans to do the right thing after they have exhausted all other possibilities, quoted Winston Churchill. Although a major uncertainty in fiscal cliff has been removed, it seems that the market has not priced in the likely decrease in consumption from the new tax codes. As shown in the chart, US real disposable income plunged into the negative territory in January. Despite recent improvement in core retail sales, consumption may succumb to weakness going forth should real disposable income remain negative. Equity returns and market fears share an inverse relationship. As S&P 500 index rise to its current level, market fear as measured by volatility index in red slumped to its lowest level last seen on Feb 26, 2007. While there is a floor to volatility index, there is theoretically unlimited upside to S&P 500. When volatility index veers off its lows, one can reasonably infer that equities may retreat. Quoting Warren Buffett, "Be greedy when others are fearful, and be fearful when others are greedy." It certainly looks like the market is overly confident of the economic recovery right now. The US debt ceiling has been reached, but it will be suspended till May 19. In the previous round of debt negotiation in summer 2011, S&P downgraded the sovereign credit rating of the world's largest economy, in view of the likely political posturing between the Democrats and the Republicans. It seems that the investors have not priced in the likely scenario of a US default in 2 months' time. Equity prices seem to have decoupled from economic fundamentals. With the US economy expanding at a mere 2% and a rising public debt, corporate fundamentals and accommodative monetary policy may not be able to sustain the party Wall Street is throwing. Market correction is highly probable in the near term. However, value stocks with stable dividend yields can weather the volatility as it comes. Investors are less likely to be rewarded for taking an aggressively risky position right now. After all, it may not be wise going to a party only to find people leaving, right? In the current investment climate, it is advisable to place money with active fund managers with proven bottom-up selection skills. Thank you for watching Phillip Weekly Market Watch. We'll see you next week.